Welcome to the Four Seasons Podcast, brought to you by B&H Wealth Strategies, serving Northeast Tennessee and Southwest Virginia since 1966. Here, we guide you through the ever-changing seasons of your financial journey, offering insights to help you grow, protect, and enjoy your wealth. Ready to turn your financial dreams into reality? Dare to dream. And now, here's your host, President of B&H Wealth Strategies, Jeff Bingham.
Retirement should be about enjoying life, not worrying about finances. B&H Wealth Strategies helps clients protect their hard-earned money while still allowing for growth. Let's dive into the smart strategies that can help make retirement stress-free. Welcome back, everyone. Skip Monty here, co-host / producer, back in the studio with Jeff Bingham. Jeff, how's it going?
It's going great. Skip, how are you this morning?
I'm doing just fine. It's for a Friday morning. I'm doing great. So Jeff, let's get right to the meat of the episode. Does B&H Wealth Strategies offer strategies for reducing financial risk during retirement?
Well, the answer to that is absolutely yes. And those, reducing risk can come in a lot of different forms, because risk really means different things to different people. I think the first thing that people think about, certainly when they're thinking about investment and retirement planning, the first risk that they identify is the risk of loss, right? That money loses value from a sell-off in the market, let's say. We're kind of tuned into that. We watch the news outlets. We watch CNBC or Fox Business or wherever we're watching that kind of thing. We read the newspapers. So we're just automatically tuned into that. And then certainly that is part of risk. But it comes in a lot of other forms too, Skip, and that's what most people don't pay attention to, maybe a little bit more now with the fact that we have seen inflation kind of return into our lives. Kind of post-COVID, inflation was running with 1% to 2%, and that's kind of the Fed target rate. You'll hear talk about inflation is at 2%, and we're closer to 3% right now, and that's, we could have a conversation about whether is it really higher than that, and it probably is for most people's purchasing items that they need, because we carve out of that inflation risk, we carve out things such as health and energy and food. And as I always say, most of my clients need all three of those, and that inflation is certainly much higher than the 2.9 or wherever the stated number is right now. But let's talk first and foremost about going back to the loss of capital, watching that money go down. The tried and true way of doing that, if you want to have an investment strategy, is you use diversification. You use stocks, bonds, real estate, various things that you can put in there. The idea of that kind of diversification, that kind of risk control, is that when one thing goes up, the other goes down, and vice versa, right? In other words, if you use a stock and bond analogy right there, that is, the yin and yang. If stocks go up and bonds are, they may not go down, but bonds are there. They're kind of the ballast in the portfolio. They generate income, and they're less volatile than stocks, and all those things are true. But the reality is that look at a time period like 2022 as an example, which is really when we saw inflation return into the marketplace. We saw the Federal Reserve begin to raise rates. And so everybody became aware of, and it had been 40 some odd years since we'd seen inflation, kind of rear up and really have an impact on the economy, and most importantly on people's pocketbooks, but also on people's portfolios. And so in 2022, as the Fed was raising rates and inflation was running near double digits for a period of time, we talked about it being transitory for a while. You heard the Fed use that term, and obviously it was not. So what happened in 2022 is that the stock market lost roughly 20% of its value, right, as measured by the S&P 500. But the bond market, right, which is where we have our safety net in the portfolios, well, it went down. It finished the year probably roughly down about maybe 13.5%, 14%, but at one time it was off almost 15%. So if you put together a portfolio, a balanced portfolio, which is 60% stocks, let's say, and 40% bonds, that's kind of the classic balanced, moderate portfolio under what is known as modern portfolio theory, something that's been around and won a Nobel Prize back in the 50s. That portfolio, if you do the arithmetic on that, that puts it down about 18.5%. And that's not what people expect when they have a balanced portfolio. The stock market's down 20, Bond market's down nearly 15, and my portfolio is off 18.5%. Did I do better than the market? Did I reduce risk? Yeah, you did, but that's a pretty painful experience for folks. So you've got to look at a lot of other alternatives that are there. And the reason why that happened, and how does the bond market lose that kind of value as interest rates are going up, is that because rates had been, for 40 plus years, really going back into the mid 1980s, the bond market interest rates had been going steadily down, right? We were double digit interest rate, we were double digit inflation, double digit interest rates coming out of the beginning of the 1980s. And from that point forward, you basically saw a slow, steady decline of interest rates all the way through until 2021, 2022, when the Fed reversed its course and started raising rates. So if you own a bond, if you think about how bonds work, they're a debt instrument. And what a debt instrument is a company or the government, right? The government borrows lots and lots of money, but you borrow money at 3%, buy a 10-year treasury at 3%. And if you own it for that time period, you're going to earn 3% on that money. But if rates go up and now rates are at 4% instead of 3%, well, everybody would rather have 4% than 3%, right? 4 is better than 3 in the interest rate environment. But you would have to sell that bond that you own and get out of it to buy the 4. And nobody's going to pay you a 1-for-1 for a 3% when the current interest rates are at 4. So they discount them, and so the price goes down. And that's what happened throughout 2022, and it's still really kind of going on out there in the marketplace. The Fed sets rates one way, but the marketplace really is what drives interest rates. And so as an example, last year, thinking about interest rates and how to control risk, and I'm spending a lot of time on this, perhaps this is too weedy for the pod. I hope that people will get something out of this. But last year, we know rates were going up to in the 4.5% to 5% range right now. Yet the bond market, as measured by what we call the Barclays aggregate, which is kind of a mixture of high-grade corporate bonds and government bonds, was up 1.5%. And that means that the price then had to go down. So if the average interest rate in that mix of assets, that basket index that we're talking about, if the interest rate's in that 4.5% range, let's say, but the bond market was up only 1.5% for the year, then how does that happen? That means it had to lose roughly 3% or 3.5% of its value, right? So instead of it being worth $1, it's worth 97.5 to 97 cents is what somebody would pay you for that. So are there other alternatives then to control risk, right? Because that's what we're talking about, to control risk other than bonds. And we're not suggesting that you shouldn't have bonds in a portfolio, but this is not your grandfather's bond market that you're dealing with right here anymore, as we like to say. So what do you use? We use something that our portfolios have, is something called options hedging, which is delivered by a group that we work with called Aptus Capital, that I'll talk about maybe one of these days in a podcast. It's just an amazing group of really, really smart people, much smarter than I am, that run this options hedging to reduce risk. And it's basically looks a little bit like portfolio or a little bit like homeowners insurance, I should say, that put an options hedging strategy in there. You have got a deductible like a homeowners thing. You pay a premium for it. So it has a little bit of a cost to it, but it's when the market goes down very sharply, your house has a large amount of damage, it's going to kick in value and create value in a portfolio and kind of go up asymmetrically, meaning that it can go, if the market goes down sharply, you don't have to have a lot of money in an option strategy, because it will go up asymmetrically on the other side in a sell-off in the market. So it can protect that portfolio by doing that. It creates cash in the portfolio, and then you have cash to buy back the stocks that have gone down in value that you might want to continue to own, right? So it creates a beautiful thing, and then you reset the options. And so it's something that not, as I like to say, the only folks that are out there that are using that type of risk reduction in a portfolio, to my knowledge, from Asheville to Nashville, we're the only ones that are doing that in a way. Now, options can have a negative connotation to the listeners out there, because you hear about hedge funds and you hear about all these kind of things that are out there, and they think, oh my gosh, this is risky stuff that they're doing. We're not trying to make money by using options necessarily. We're trying to hold on to money by using options. So it's a risk reduction strategy to hold on to money, because again, the loss of math is merciless in a portfolio, right? If you lose 10%, if you go down, if you have a portfolio, it loses 10% of its value. If you come back 10%, are you back to where you were? Most people, when they first ask that question, so it goes down 10 and you earn 10 on the backside of it, are you back to where you started from? And most people, if they answer that question real quickly, will say, yeah, I mean, you already go down 10, you're back 10, you should be right back to zero. But you're not, because if you lose 10% on $100,000, so I can do easy math on this, then you're back to 90,000. You go to $90,000. If you earn 10% on $90,000, you got $99,000. It takes an 11% return to get back, and that kind of math, right, just continues to get worse. So if you're down 20%, it takes about 24% to get back to even. If you're down 50%, it requires 100% return to get back to where you were. So the loss of math, right, is merciless when it comes to portfolios. So one way we do it is through diversification. Another way is through the options hedging strategy that complement the bonds and complement the stocks in a portfolio. So you're not eliminating either one of those. You're not getting rid of bonds, but you're using other techniques that are in there that, in my opinion, and I've been doing this a long time, is it is a much, much more elegant and effective and efficient way to help manage risk in a portfolio. And then there are other things, and I'll stop here and maybe let you come in and fill in a little. There are a lot of other things that we can use to reduce risk in a portfolio that are out there as well. From using, we have what we call protection and participation strategies that are out there, where you can kind of have some defined outcome type of portfolios. You can kind of set some loss limitation in a portfolio, but you also set your upper limit. You're not going to be able to make as much money if you have those kind of guaranteed and protections that are in there. But again, very attractive ways that most of my clients really, really like to have in their portfolio, because again, as you move into retirement, and for most people, even before they move into retirement, nobody likes to see their money go down in value. Nobody, not me, not my clients, not anybody that's out there listening. But if you're going to invest and try to beat inflation over time, you're going to have to own growth assets. You're going to have to own stocks to keep up and beat inflation, to make sure that your purchasing power doesn't get eroded. So how are you going to do that? How are you going to stay engaged? When you read the news and you see sell-offs, when it comes screaming and raging at you, you look at your 401k portfolio and it's gone down in value. It's a scary thing. And that uncertainty with all the noise that comes at us all the time about those things, right? And that are going on, from wars to inflation to changes of administration, all the things that go on out there. You see loss and you get uncomfortable. And that's when people make mistakes, is when portfolios go down and they start hearing all the noise. The news is kind of noise. What is that? You got to filter that noise out and come back and say, what does that mean to me specifically? Is my portfolio going to be affected by this? Am I built to survive through these kinds of environments? And that's what we try to make sure that we're doing for our clients, is we build a portfolio that is going to thrive in markets that go up, right? For sure. But it also needs to survive during stormy seasons. And there will be plenty of stormy seasons that are out there. In 35 years, I've navigated through a lot of stormy seas for clients.
I'm sure. Option hedging. That's a new term for
Yeah.
me. But a good one. So you mentioned, Jeff, diversification playing a role in protecting assets during retirement. Does that change over time? This may be a whole nother episode, but as far as how you diversify depending on what stage of life you're in, could you talk about that?
Yeah, and it's a great question, and one that comes up all the time, because the idea is the younger you are, and when you're adding money to a portfolio, can you be more aggressive in your portfolio? Diversification, in other words, what that means in simple terms, I guess, is that you own more stocks than you do bonds, right? You take more risk, and so you become what we would define by category would be a growth or perhaps an aggressive growth investor. And that just means that the ups and downs of the market are not going to affect you as much, because this is money for tomorrow, not for today. And then when you've got a 401k plan or something similar that you're participating in, you're adding money to that portfolio all the time. The times that the market goes down, a lot of people want to stop buying during those times because I want to wait till it settles down to see what's going to happen. That's when you want to be buying like crazy when you're younger and adding money to a portfolio, because it's putting the things that you want to own on sale for you right now. Again, I can't tell you what's going to happen tomorrow, but I do know what all the yesterdays look like. And there's not been a time yet in history when the market, when it's gone down, it hadn't come back and gone back to higher highs, right? So you want to be a buyer during that category. And if you've got, 20, 30, 40 years in front of you. You should be a growth, a fairly aggressive investor. You got to make sure that you can stomach it, right? Because the last thing you want to do is watch a market go down. You got some money invested in it in a 401k plan. It drops in value by, 20 percentage points or whatnot, which means you got to sell assets that you own, right? If you're going to reduce risk, you're going to sell them to somebody else. There's two sides of a transaction. When there's a sell of an asset, there's got to be a buyer of it. So somebody's going to buy it from you for a lower cost than yours was, yesterday, let's say. So who's going to win that transaction? Are you going to win it by selling it to that person, or is that person buying it going to win that transaction over time because they're getting a discounted price and it's going to go back up tomorrow, so they're going to be there. And then you're going to have to go back and get back in because you're going to look at it and say, well, I need to get back into the market, and you're going to buy it back at a higher price, right? So the winner in that transaction is usually the buyer at lower cost, right? But we are conservative and conservators in nature, humans are, right? We want to preserve our things. So I get that. So the psychology is to jump out. But really what you need to do is make sure you keep buying, right? Be more aggressive, or certainly don't slow down your buying in that 401k plan. Maybe turn it up if you can, but that's a way better idea than turning it back. Like, no, I'm not going to buy anything. I don't want to wait and see what the market's going to do. And I've heard it for years and years when I've been here. It's not, I understand it from an emotional response, but from a financial perspective, it's the worst idea that you can execute, really, in that regard. So again, the younger you are, the more risk you can take. And then the rule of thumb is that, and as you move closer to and then into retirement, what do? You get more conservative in your investment strategy. Right, you want to really turn back the dial on that and get more and more conservative. But really what you need to do is you have a risk profile. You need to understand what your risk tolerance is, right? You have to understand it's a one size fits one. But as far as getting really conservative in retirement, you don't retire on a lump sum of money, Skip. You retire on the income that a lump sum of money will generate over a long period of time. So if you retire at 65 years old and you want to get very conservative, which a lot of people will want to do, it's the instinct. It's kind of what we've been taught over long periods of time as well. It's kind of conventional wisdom, let's say. But how long do you plan on being retired? And if you're going to live from 65 and you're going to live through life expectancy, you've got 20 or so, right? By the way, a couple age 65 retiring, there is an over a 50% probability that one will be alive beyond age 90. And so you're looking at a 25 to 30 year runway at a 65-year-old. So that money, by getting more and more conservative, taking it to the bank and trying to be really conservative, kind of have that risk-free rate of return, or putting more bonds in, as we were talking about before, than you do stocks. My dad used to say it's a way to go broke safely, because you're just going to erode your purchasing power. It's attractive thinking about money in the bank today at let's say you can get 4 to 4.5 on a CD or a money market account, something like that. Rates have come down a little bit out there. But again, inflation is running reported by the CPI number is running at 3%. And then you got taxes on top of that when you're taking the money out to pay. So that money is really backing up. You're really reducing your purchasing power. The only way that I've seen over long periods of time is you have to have growth assets for your purchasing power to keep up. And so therefore, you're going to have to continue to have things like stocks in your portfolio, real estate in your portfolio, those kind of things that can beat the rate of inflation. Because again, over 25 years, even at a modest 3% inflation, that means your income has got to double. So if you need $4,000 a month now, 20 years from now, or 25 years from now, that $4,000 a month is going to need to be $8,000. If inflation stays where it is kind of running right now over a longer period of time, you're going to need to double up that income purchasing power a lot sooner than that. So the rule of thumb is we want to get more conservative as we move into retirement. And there's some truth in that, but to get too conservative is a way to make sure that you're just going to run out of purchasing power, right? And so our job on my side of the table is to try to keep people, to have enough growth in their portfolio, but enough risk reduction in their portfolio to where they can be financially and have financial freedom throughout their retirement, but also that they can put their head on a pillow at night and sleep.
Awesome. Wow. So diversification plays a big part, obviously a lot to unfold, and unfortunately we're out of time for this episode, but I'm hoping that in our next we can continue this conversation, talk about diversification, and would really like to talk about your Four Seasons GPS tool that you guys have in the next episode. if we can do that.
Yeah, and I think that's where what we talked about right here will come to light a little bit more clearly, perhaps. And, and again, I apologize to listeners out there if that was a little more weedy in some of the things that I talked about. So hopefully that was somewhat understandable, I hope.
Absolutely. Well, like I said, there's a lot to unpack, but we'll catch you in the next episode where we'll talk about that GPS tool.
Looking forward to it. Thanks, Skip.
Thanks for tuning into the Four Seasons podcast, brought to you by B&H Wealth Strategies, where your financial success is our priority. Schedule your free 20-minute consultation today by calling 423-247-1152 or by visiting bhretire.com. Take the first step toward making your financial dreams come true. Until next time, remember, every season is the right season to plan for your future. Securities and registered investment advisory services offered through Silver Oak Securities, Inc., member FINRA SIPC. B&H Wealth Strategies and Silver Oak Securities, Inc. are not affiliated.